system to make a video about how you can actually take consistently winning trades using ICT concept. So I got this from ICT 2022 mentorship. I will leave the link to his channel in the description below. So for those who don't know who's ICT, okay, so in this video, I'm going to show you how you can consistently take winning trades. We're going to use the replay tool so that we can use all the data, but you will be able to see this when you're looking at the chart. So the more time you spend at the chart, is going to be much easier for you to see this happen. So before I show you how this can happen on the chart, I want to give you a diagram so that it's easier for you to understand. We know that the market moves in impulses and corrections. So let's quickly draw an impulse and correction. The ICI, impulse, correction, impulse. So this is the nature of the market. We know that the market moves in impulses and corrections. So from the ICT mentorship, what I got and what I liked was the idea of taking trades based on the fair value gap. So if you are taking trades based on the fair value gap, you need to make sure that the fair value gap is below the equilibrium. So suppose this is a break of structure. Suppose this is a break of structure, right? And then this is a valid high. Let's mark that again. This is a valid high and this is a valid low. So this is actually our trading range. We're having an impulse, correction, impulse. So we want to see price coming to tap into the fair value gap, imbalance or inefficient price action before continuing with the uptrend. So this is the idea. And then the most important thing for you to make sure that you're taking higher accuracy trades, your imbalance or fair value gap needs to be below the equilibrium. To find the equilibrium, you need to mark from the swing low to the swing high of your trading range. The 50% is your equilibrium. And then we know that between the 61.8% and the 78.6% is the golden zone. If you find a fair value gap which aligns perfectly with the golden zone, that's where you want to take the trade. So you're going to be taking the trade on the fair value gap. So I prefer using limit orders. So you can use a market order, but I like limit order so that I do not miss the move. So if you look at this, this will be an idea. You wanna be tapped into this trade below the equilibrium specifically, or preferably in the golden zone, and let it run. And then your first take profit is this high. The moment you tap into the fair value gap, this will be your first upside target. And then once this first upside target gets taken, you can go break even on your trade. So this means if this first target has not been taken, you shouldn't be going break even. You can allow yourself to lose the trade if the market decides to plummet lower. So if something like this happens, you should be okay with losing the trade. So with that being said, the losses will be inevitable. You need to be able to lose correctly. So the idea is that after taking this high, you can remove the risk on the trade, and then you can hold for as long as you want. You can even target this Fibonacci extended target, this one. But you know that you only need a minimum of 1:3 to take a trade. And then from ICT, you can simply exit all your position right here with the potential 1:7. Okay, I prefer 1:3. So everyone is trading differently. You simply learn from other people, and then you create your own trade plan, and then you follow your trade plan. So if we're in a downtrend, it's still gonna be the same. And then you wanna take trades where above the equilibrium, Okay, you wanna take your trade above the 50% or equilibrium. which will be the premium zone. So if you are in an uptrend, it's gonna be in the discounted zone. You need a minimum risk to reward 1:3. So that's what I recommend. Other traders recommend 1:2. ICT, I think, does even recommend 1:1 at some point. Okay, so 1:3 works best for me. 1:3. I recommend 1:3. So that's the idea. You want to take trades in the fair value gap or on the fair value gap, which is above the equilibrium. So let me quickly show you this on the chart. So if you are enjoying this video, kindly hit the like button. Comment structure is king. That shows how many of you guys managed to get to this part of the video. Okay, so let me quickly play the candles and show you the idea. You can see that here we're having an impulse, and then here we're having a correction, and then we're anticipating another impulse to the upside. Once we have the impulse to the upside, we can start looking for our fair value gaps or imbalances. Another important thing you can see here is that this trade rejected from this imbalance or fair value gap. So these fair value gaps are getting respected as forms of support and resistance. So this fair value gap acted as a support level. And then which fair value gap would you like to see acting as a support or resistance level? So let's quickly start mapping the imbalances. We have this imbalance here. Is it above or below the equilibrium? Let's mark the trading range. And then we can see that this fair value gap is above the equilibrium. So let's mark another one. We can see that we are having this one. This aligns also perfectly with the golden zone. So this is where we would want to be triggered in the trade. So we can see other levels of imbalances. We have this one also. We have this imbalance there. So another question will be which fair value gap are you going to use? So for me personally, as long as it's below the equilibrium, you can use it. But I just wanted to mark these fair value gaps because one of my students was asking me today, how do you find the fair value gaps? So the fair value gaps, you need 3 candles. You need 3 candles to find a fair value gap. When the high of the first candle does not meet the low of the third candle, that's your fair value gap. So if that did not make sense, you can simply watch the video again. When the high of the first candle does not meet the low of the third candle, that's your fair value gap. Okay, so it's gonna be vice versa when you are trading to the downside. So we can also identify the structure break here. This is a break of structure. So this tells us that we're in an uptrend. If we had a break of structure to the downside, we're in a downtrend. So the break of structure tells you the market intent. So let's mark again the trading range. We mark the swing low and the swing high. And then if you do not have these settings, you can pause the video and then I want to show you the coordinates. You can pause the video and copy these settings, and then you're going to have a similar Fibonacci tool as mine. And then you want to take trades in the golden zone. Okay, so where are you going to take the trade? You're going to use a buy limit. And then your safest stop loss recommended by ICT is below this old low. And then your first upside target is this high. So again, this is where you wanna go break even. As soon as this high gets taken, you wanna remove the risk on the trade. This will be TP or target. And then I prefer using buy limits. So you can see that this is a potential 1:1.6. And then I prefer 1:3. And then that means I will increase my target like that. And then there is another way to find the target. So I'll show you in a sec how you can find the target. Sorry about that, guys. In order to find the Fibonacci extended target, you need to get the structure shift. So I will show you in a sec. So this will be the bad fair value gap, which you don't want to take because it's above the equilibrium. And then this will be a good fair value gap you want to take because it's below the equilibrium. And then once the market taps into the fair value gap, we are anticipating a market structure shift or a change of character. Once this high gets taken, that's your market structure shift or change of character, or order flow realignment, as I used to call it. I want to show you something. Right, at this moment, that's when you can find your extended Fibonacci target. You're going to use the Fibonacci tool again. You're going to mark this low and this high, and it's going to give you this Fibonacci extended target. This will be your take profit 2, and then this will be your take profit 3. So you can see that if you try to use this target, you might not get the 1:3. So in order to get the 1:3, you might need to reduce the stop loss. So that's gonna depend on your trading style or how you like to trade. So now we can see that we're having this first upside target, and then this is a confirmed low because we have taken this high. We have shifted the structure. So let's hit play and see how this goes. And then you do not go break even until your first target is taken. And then as soon as you take your first upside target, you can remove the risk on the trade. You can go break even here, meaning there is no longer risk on the trade. And then you can see take profit 2 has been achieved. Let's see if the take profit 3 will be achieved. Okay, so it doesn't get achieved. So this is the idea. It didn't get achieved, but you know that from the ICT concept, you need to be exiting the trades right here. So for me personally, I like holding longer. I like letting my trades run. So if you didn't exit, this is a potential break-even trade. You get stopped out on break-even. It means you didn't make money and you didn't lose money. So that's the idea why you should remove the risk or you should exit your trade right there. So everyone is trading differently. If you enjoyed this video, kindly hit the like button and comment structure is king. And if you want to be my student, if you want to learn from me, if you are a beginner, if you have been trading for a while, you can join my Patreon. The link will also be in the description. So if you want to learn from me personally, get one-on-one lessons, I will teach you how I trade. I also use these concepts from ICT. And if you want to learn how I trade, you simply sign up on my Patreon, and then you will get access to one-on-one mentorship lessons. So that will be the end of the video, guys. And again, if you enjoyed this video, kindly hit the like button, comment structure is king, and I will see you guys in the next video. Signing out.